Hi, I'm Theo, a leading real estate and mortgage professional. Here are 5 factors mortgage lenders consider when they are assessing your loan application. Things have tightened up in the housing market since the changes in interest rates, and lenders are looking at applications much more closely. Lenders consider many factors before deciding whether to approve applicants. Once you know what they're looking for, you can boost your chances of getting approved. Check out factors that mortgage lenders often consider. Number 1, the size of your down payment. When you're trying to buy a home, the more money you put down, the less you'll have to borrow from a lender. Making a sizable down payment might also improve your chances of getting approved for a loan. If you can put down enough money, you could be considered a low-risk borrower in a lender's eyes. Industry standards say that home buyers applying for conventional mortgages should put down at least 20% of their loan amount. But it's important to make a down payment that you can actually afford. Certain mortgage programs, like the FHA loan program, allow qualifying buyers to make smaller down payments in exchange for agreeing to pay for private mortgage insurance with an additional monthly payment. Shop around, as lenders are always competing and come up with new loans all the time. Number 2, your credit history. Looking at your credit score and your credit history can give a lender a sense of how you manage money and the likelihood that you'll be able to pay back your loan. Mortgage lenders often look at FICO credit scores, and the scores that they require borrowers to have tended to vary. Before you set up an appointment with a lender, it's a good idea to review your credit report in advance. It's a good idea to get free copies of your credit report from the 3 major bureaus through annualcreditreport.com. As you're reviewing your credit report, it's important to identify any mistakes that could bring your score down. Your credit score could impact everything from the interest rate you qualify for to your loan terms and conditions. Number 3, your work history. In addition to reviewing credit histories and assessing the ability to make a down payment, banks and lenders often review their applicants' employment histories. Lenders want to ensure that borrowers can afford to make regular mortgage payments. You will need to prove that you have a steady source of income, so it's best to avoid quitting your job or switching careers before you apply for a mortgage. In fact, many lenders will want to see 2 consistent years of employed income. If you own a business and that's your sole source of income, then it could be troublesome for you, as the way the business is taxed will determine how the lender must look at your income. If your business has a tax loss that falls to your personal return, for example, then it doesn't look like you have any income to the lender. Number 4, your debt to income ratio. Home buyers often borrow hundreds of thousands of dollars when taking out mortgage loans. So, before a lender will approve you for a loan, the lender will want to know about your existing debts and your ability to keep up with your debt payments. Your student loan debt, credit card debt, and other debts will be taken into account when your lender looks at your debt to income ratio, or the size of your monthly debt payments relative to your monthly gross income. When it comes to debt to income ratio, DTI ratios, different lenders have different requirements. But in many cases, lenders tend to avoid lending money to applicants with DTI ratio above 43%. That's because lenders want to ensure that borrowers can make all of their monthly payments without overextending themselves. If you want to keep your DTI as low as possible and improve your chances of getting approved for a mortgage, it's a good idea to work on paying off large debts before turning in your application. It might also be wise to avoid applying for new lines of credit or making large credit purchases before meeting with a lender. Number 5, the type of loan you're interested in. When you meet with your lender, be prepared to discuss different loan options. You might not be able to get a conventional loan if you can't meet criteria set. Even if you can't qualify for a standard loan, Your lender might not approve you for the loan amount that you are interested in getting. Different kinds of loans come with different rules and requirements. Before you contact the lender, it's important and wise to look at the qualifications for multiple kinds of loans in case you're not eligible for the kind of mortgage you had your heart set on. If your income is tight or your credit score is challenged, but you are 62 years old and have large equity, 50 to 60%, seriously look into a reverse mortgage. You may qualify and help your financial situation. I'm an expert in reverse mortgages with over a dozen years of experience, and I've done hundreds of reverse loans. I can educate and guide you. The bottom line, every lender is different. That's why it's a good idea to find out in advance what different lenders are looking for so you can put your best foot forward. Ultimately, you'll need to be honest with your lender if you want to get approved for a mortgage. Misleading your lender or hiding information won't make your situation any better. And it could come back to haunt you if you're stuck with a mortgage that you can't afford to pay. Make sure your credit score is in good shape. With a high credit score, you can get lower mortgage rates, which translates to lower monthly mortgage payments. If this was helpful, please leave a comment or an emoji and enjoy your day.